Okay, well, with that, I'll get started. Also, Mike will be posting a link towards the end of the presentation to an evaluation form. So please feel free to click on the link, go to the evaluation form, and give us your thoughts and feedback so that we can make these presentations better. Anyway, who I am, my name's Peggy Evleth. I am a manager in the RSM NetSuite practice. I am based in RSM's Denver office. I'm also a board member of the Rocky Mountain NetSuite user group. My specialty is actually global initiatives with NetSuite. I'm a functional consultant with that does a lot of solution architecting. I have a long-standing background in international accounting and international currency consolidation, which is what I did before I was a controller that specialized in that before I became a consultant. So what I want to start with is talking about some of the basic terminology, because this is where people initially kind of get confused. So things like, what are functional currency and why does it matter? And Mike, could you grab that link that's in here and maybe paste it into the chat? Because it's a blog that RSM, one of the RSM management consulting directors has written. I think he may be a partner now, but anyway, Graydon Smith has written a blog on functional currency. So what is functional currency and why does it matter? So functional currency is the currency that your general ledger is denominated in. You have two situations that can occur. You can have your functional currency be the same as your local currency, or your functional currency isn't the same as your local currency. ASC 830, for those who want some really exciting reading, outlines some criteria for how to decide what your functional currency is. My suggestion on functional currency is, if you are not sure, talk to your accountants, because they will be able to guide you on that. For the most part, if you have a significant presence in a country, in other words, you have payroll, you have brick and mortar locations, you do significant sales there, you carry inventory there, the vast majority of your expenses occur there and are denominated in that currency, your functional currency will probably be the local currency. If you're maybe just a sales office that doesn't have a significant presence in terms of brick and mortar, inventory, things like that, in many cases, a company will choose for the functional currency to be the parent's currency. So I have a sales office in Ireland, I'm a US company, I could choose to have the functional currency be the US dollar as opposed to the euro. If there are local currency that reports that are needed and your functional currency is not the local currency, you can either do it manually, which is kind of a pain in the butt. You're reporting by Excel at that point, or you can get Multibook installed on NetSuite. And what Multibook provides you with is the ability to actually track two sets of ledgers, one in your functional currency and one in that local reporting currency. That's what a lot of people will choose to do when they have a situation where they have determined their functional currency is not the local currency. NetSuite supports functional currency as the local currency better. It kind of assumes that's going to be your default in most cases, and it is really set up to do the reporting better with that type of situation. The other thing that you run into when your functional currency is not your local currency is that there is a gain or loss on many transactions that you will post, and which takes us into different types of gain or loss. So realized gain and loss. This is when a monetary transaction has been completed in a currency that's not the functional currency. which takes us back to why if your functional currency is not your local currency and you have a lot of expenses in your local currency, now you have a realized gain or loss on any monetary expenses, any AP that you have, any AR that you have. So why do I have a realized gain or loss? I receive an invoice on day one. I'm a Euro company. I receive $100 $100 invoice. It translates on that day to 92 euros. I pay it in 30 days. I pay $100, but now it's 94 euros. So I have a €2 loss on that transaction. You also have unrealized gains and losses. That's when you have a situation where you haven't done that complete life cycle that I talked about in the previous example. So I have received that $100 US invoice. It translated to 92 euros when I got it, and now I'm at month end. It's not paid, but now it is only 91 euros. So I actually have a €1 gain. GAAP expects me to recognize that change in value at month end. So what I do at that point is I will book that €1 into an unrealized gain at that point to reverse the following month. And then when I actually pay the invoice, say middle of the month, then I actually have the realized gain or loss that gets put in at that point. The third piece where people get confused is the CTA. So you've got actually two different types of translation going on. You've got realized and unrealized gains and losses that are transactionally based. You've got the cumulative translation adjustment that occurs when you take a set of results, so a trial balance, from a company whose currency is not the parent's currency, and you translate it. When you translate a trial balance, you use 3 different rates, and I'll show you where all these rates live and everything in NetSuite. But you have 3 different rates that apply when you are translating the financials of a subsidiary that is not denominated in the currency that is your parent's reporting currency. Income statement accounts are translated at an average rate of the month. Balance sheet accounts, except for equity and a couple of other exceptions such as intangibles, are translated at the rate on the last day of your reporting period. And those other exceptions such as equity and things like intangibles, excuse me, are translated at a historic rate. In other words, it takes the rate that it happens and it will translate it at that rate forever and ever and ever. So those are things, it is important to understand the difference between transactionally related gains and losses, such as the unrealized gain and loss from AP or AR, and that CTA adjustment, which is an off-ledger adjustment. It doesn't actually have a home to live in. It's not a journal entry. So realized and unrealized gains and losses are actually entries to ledgers. CTA fundamentally, and people hate it when I say this, but it's true, it's a plug. Because of the fact that I'm taking a trial balance that in the functional currency balances, I'm translating elements at 3 different rates, which means that in the reporting currency, it's not going to balance anymore. So whatever that out of balance is gets shoved into CTA. Okay, so let's talk about setups. I'm going to go through some of the setups so that you guys can see where these things live. So I'm going to go over here. I'm going to stop sharing this screen and I am going to share my NetSuite screen. Okay, can everybody see NetSuite?
Yes.
Okay,
And
so
Peggy, you
yeah,
also have a question in the chat too. I don't know.
yes.
Okay.
Yeah, I can't see the chat. I got too many screens. Can you
Okay.
let me know what it is?
Yes. Is the unrealized or realized gains and losses based on the rate set as of the date of the sales order?
It's set based on the rate of the transaction, not the sales order, because the sales order is not an accounting event. So as a general rule, it's going to be the invoice date, not the sales order date.
Okay. There's a second question. Is
Yeah.
the CTA a GL in the home chart of accounts?
It is a system account, and
Yeah.
you will see it there. You'll see two CTA accounts. You'll see CTA and CTA elimination. And I'll just talk briefly on CTA elimination, what that is. It's another CTA account, but it has to do purely when you eliminate intercompany balances, and because of foreign exchange, you've got a slight difference when you do your eliminations. For example, if I have an intercompany sale or an intercompany, so company A charges company B a management fee. Company A charges company B a management fee of $100, which company B takes in as 80 euros. Now that 80 euros is not going to translate back at the end of the month to $100 because it was booked, the 80 euros was booked at the rate that the management fee was charged, but that 80 euros to translate back into US dollars for consolidation will be translated at the average rate of the month. So now it's going to translate back to $100.50. So when you do the elimination of those, you've got 50 cents that needs to go somewhere in the elimination company, and that will go to the CTAE. And that creates an actual journal entry in your elimination company. Whereas regular CTA that arises from the exchange rate differences when you translate does not end up as an entry anywhere. There is a CTA audit report, which I'll mention later, that is really ugly. You can use it. It's really ugly. What I do when people ask me is I will create a balance sheet. You know, if I want to see what my CTA is and recreate it, create a balance sheet where you have one column that is in the functional currency, one column that is in the reported amounts in the reporting currency, so say US dollars. So first column's in functional currency, second column is going to be in US dollars in this example. The third column will take what's in column one in the functional currency, multiply everything by the month end rate, and then you'll have a fourth column that'll figure out the difference between the two. And that's where you can calculate your CTA quick and easy, back of the napkin, as opposed to trying to rely on the NetSuite report, which is super hard to read. Another question there. Best way to get CTA by subsidiary in a TB report. You can use the CTAE because it does break it out by subsidiary, or you can do the process that I just described, which is doing side-by-side balance sheets. If you need to see where it's coming from, I mean, personally, I probably would do the side-by-side balance sheets just because I find the CTA audit report difficult to read. But those are two options for getting that information. Okay, so here we have, under our lists, accounting, I have my currencies. So when I need to add a new currency, I can simply add new. I add the name of the currency, the ISO code, and then I need a default exchange rate. Your default exchange rate will be the number of those currency units per US dollar. So for example, if I'm doing the yen, it'll be 100 and some odd yen for $1. You need this, so it's starred, so obviously you need it. And the reason for that is so that it has a place to start. However, most people will use the auto update. So when you do your initial setup under enable features, you've got a spot under general way down at the bottom where it tells you where are you? International, there you are. So currency exchange rate integration. Now here they didn't change this. Okay, no, because here that this foreign exchange data by X night, you actually have two options now. So if I go to my accounting preferences, I can actually choose between Xignite and HSBC. Down at the bottom here. So if I don't like Xignite, I can change it to HSBC. Those are the two available. Keep in mind that some jurisdictions might require you to use a central bank rate, at which point you're going to need to reach out potentially to a third party, or if you have in-house abilities, you'll need to reach out and get some scripting done to go and grab those specific rates for those countries. Some of the localizations for different countries do have that built in. However, that is something that you do need to keep an eye on. Accounts. So we were talking about those rate types. So here I want to talk about a couple of things in the account that are crucial for working with foreign exchange in NetSuite. So here, you've got two rate types here. This is the one that people mostly use. This is the one that you need for consolidation. So if you remember earlier, I talked about current versus average versus historical. This is where you are going to tell NetSuite what this is going to be translated at. Now, it is going to try to fill it in for you. So if I select a other current asset, it's going to think current. If I select other income, it's going to try to say average. So it will try based on, and if I do equity, it'll come in at historical. So it will try based on the type that you put in to put the correct rate type. It will be correct 98% of the time, but you do want to double check it and make sure it's doing it correctly. If you change it, you need to understand why you're changing it, because it can make it makes a big difference. And I've seen sometimes situations where just accidentally somebody will be translating an income statement item at current, and it's not correct, and it will skew all of your reporting. And the problem is, if you go and change it, now it's going to skew all your reporting backwards when you change it. So you want to make sure when you add a new account, or if you're uploading a chart of accounts the first time, that you get this information correct. There are also cash flow rate items. So again, average, current, historical. However, your cash flow statement sometimes treats things a little differently than it does with your standard consolidation. I don't know a lot of people who are using the cash flow statements in NetSuite for international, because cash flow statements are rough to begin with, and once you start getting into an international realm, they get complicated, and a lot of times people will go with a CPM tool once the reporting starts getting overly complicated, or they end up relying on Excel, which is also pretty common. The other thing up here that's important, so I'm going to just put a sample. So here, I know 1501 is normally not a bank account. I'm sorry. Okay. All right. So what I have here is I've started creating a bank account. Now up here, there is a box that says revalue open balance for foreign currency transactions. That is where you tell it whether or not it is a monetary account that you want to revalue. If you remember back a couple slides ago, I talked about monetary versus whether or not, your unrealized gain and loss and revaluing monetary accounts. This revalue open balance for foreign currency transactions is for monetary accounts only. ASC 830 is really clear on that, that it's monetary accounts. What's not so clear is they don't tell you what a monetary account is. So is monetary account an accrual account? What if I know the exact amount of the accrual? Is it a monetary account then? Is a bank account a monetary account? The short answer on that is yes. Bank accounts, AP and AR accounts where you've got actual documents where you are going to either pay or collect them at a specific time frame, those are clear cut. Some of the others are not as clear cut, and my standard answer on this is if you're doing a lot of transactions that are not in your functional currency, double check with your auditors on those accounts. Send them the chart of accounts and ask them which one of these should be revalued. Your auditors should be able to provide that information, or what we have done here at RSM is sometimes when the client's not sure and we need a little help, we go to our technical accounting folks. Say, hey, we need you guys to give this your blessing or tell us if we've messed something up. So when in doubt, check with the auditors. All of these exchange rates, you've got a couple of different places where the exchange rates live. You have two exchange tables, and it's also important to know what exchange tables you have. So you have the currency exchange rate page and the consolidated exchange rate page. Your currency exchange rate page is the exchange rates that are downloaded on a daily basis. So here are the exchange rates that were last done on 8/4/17, because this is a sample. This is sample data, but I can go back here if I drop down on the filter and I need to see something like 7/31/17, because I see that's when they have data. So here, if I select that, now it will bring me those rates. So that's where you can see what rates it is using to translate. Now here, these are these are horrible exchange rates. Okay, don't look at the numbers. It's a sample. Oh, that's actually towards the yen. So here it's got yen versus krone. Here are there we go. That looks a bit better. So US dollar versus GBP, euros to US dollars. So and this is actually quoting. So this is number of US dollars per euro. This is number of US dollars per GBP. And here, and they've got that quoting direct, but and their number of New Zealand dollars per US dollar. So sometimes it can be a little confusing how they quote these. And anyway, you can always double check in your transactions and see if it's translating right. What I do when I initially set stuff up a lot of times is I will grab my phone, grab my little Oanda app that I've got on my phone, and do a sample calculation to make sure that everything's coming in right when I first set it up with that initial currency rate. The other one that we have is the consolidated exchange table. So here, this is the one that calculates for consolidation purposes. So here is your current, your average, your historical. Now, this, when you set these up, so this is all the way to 1999. Let's see if we can get further in than that. Let's go to like here. No. So in your systems, once you're doing the downloads, you'll actually have a little calculator here. And see, there's also a button up here that says calculate. What NetSuite does for calculating the average and historic rates is it does a weighted average. So it looks at all of the rates for the average, all of the rates of the month, how many transactions, what the total volume of transactions that you've done on that particular day is, and it calculates a weighted average. When you go to your month-end close process, you'll see that you'll have an item that says calculate consolidated exchange rates. Don't miss that step. Go in and do that step, because what that's going to do is that's going to calculate the average for you. So for here, for example, I can see that that hasn't been done anywhere because my average and my current are the same. They should not be unless you have absolutely zero transactions for that subsidiary. So, my test investment or my Canada, if I have zero transactions in January of 2018, my current and my average will be the same. However, most people actually have at least a few transactions, so I should have a difference between current and average. The other thing I want to point out as a caveat, where you might actually have to edit these rates yourself, which you have the ability to do over here with the edit, is if you have a situation where your foreign subsidiaries, oh, okay. I could edit it if it weren't in a closed period, but anyway, it will bring you, let's see if I can get to a period that's not closed in here so you can see what the screen looks like. Here's a calculator. There's your little calculator where it's going to calculate the rates. And here, if I need to go in and change it, that's where I can change it. So if you're importing transactions from another system and you import them on the last day of the month, you're going to want to enter a current exchange rate. Oanda will calculate, sorry, not the current exchange, the average exchange rate. Oanda will calculate that for you. You can go on their free currency calculator thing and you can get it to calculate the average for the month. The reason it won't calculate it accurately for you when you are importing a trial balance on a monthly basis from another system is you're generally importing it for one date and it's the entire month's activity. So now you've got a situation where for NetSuite calculation purposes, it only is able to look at one transaction to do that average calculation. So if you've got that situation, you're going to need to come in and update your average exchange rate. The historical exchange rate is frequently the same as the current exchange rate because the number of accounts that the historical exchange rate applies to is pretty limited. And there aren't very many transactions inherently that take place in those accounts. So for example, additional paid in capital is something that's translated at historic. However, you don't do transactions to additional paid in capital very often. So that's something where it is common to see that be the same as the current exchange rate. If you only have one transaction and it takes place on whatever day at whatever rate, then it will automatically, if it's the only transaction, it'll automatically calculate it at that rate because that is the quote unquote average. So there is a question in here. What happens if you buy currency at a set rate? The functional currency is the CAD, but you buy USD several times per week. Is there a way to apply the rate to the payables when we pay bills? Yes, there is. So you can override the rates on on any of your transactions, basically. And let's actually, that's a great segue. So let's actually look at what it, come on slide. Oh, that's right, I'm sharing screen. So what we're gonna do, we're gonna talk about a transaction that would create a realized gain and loss. We'll just go in and go into, for example, okay, no, transactions, there we go. Payables, enter bills. Now, key, if you're entering bills in a functional currency that's not, or sorry, in a currency that's not your functional currency, your vendor has to be set up for that. And the vendor will try to default to the subsidiary if, like here, this is a UK company. Over here's my currency. However, if I change, for example, to Aussie dollars, you'll see that it is pulled in an exchange rate for the day in question. However, to answer the question that we were asked about changing the rate, I can change it right here. There was a quick question on explaining again how the system is calculating my average rate for consolidation. It is taking a weighted average of all the transactions in that month. So if I have, say, $5,000 or 5,000 euros worth of transactions on day one, and the rate is this, and 2,000 on day two, and the rate is that, it's going to calculate a weighted average exchange rate. Hopefully that answers that question. It is a weighted average based on the transactions that have happened and the dates of those transactions. So here, it's going to have this exchange rate. It is going to book it. So if I book this into a category, oh, okay, let's see, say 100 Aussie dollars. There's my tax code. So now when I save it, oh, it's because of that. Always love that. I'm not going to talk about VAT in this session. You will thank me for it. So what you're going to see once this is done saving, because we are in a demo account, and we all know that NetSuite demo accounts are super fast, you'll be able to see under here your GL impact. So remember, it's 120 Aussie dollars, and here is what it booked in pounds. So you can always see what it booked in pounds. So now if I go and make a payment, transactions, payables, pay single vendor. Bill payment, let's choose Mr. Smith. Or Adam Young, that's right. And now if I'm going to choose the Aussie dollars again, because that's what we had. And see, here's my bill. And here's the exchange rate for the day. When I apply it to that bill and save it, it will create two entries. You'll see this entry where it will post it, but it will also create another entry in the ledger where you're going to see that FX piece. So here it's taking out that 68, but it's going to have the other piece. So if I go to my UK operating account, I'm going to have an FX piece in there as well. Okay, it's not showing up. It's probably in the AP account, which is why. Okay. because it's not going to be on the cash side, it's going to be on the AP side, duh. And there it is, boom. So we actually paid this amount. This is what it actually cost us, and it's going to take care. So this, you know, we had credited AP, debited AP, and then there's the 831 to balance it out. Now it's going to put it into the realized gain and loss account that you've selected. You have the ability to change those accounts. There's a setup spot where you can go in and actually change how you want it to post. And so just a couple questions here. All right, so no, currently there's no way to have NetSuite calculate it on the average daily rate. It only has one calculation method for calculating your average, and that is the weighted average method. There is no setting that you have to enable to have the system populate the consolidated exchange rate table. It knows that it's a feature that comes with OneWorld, and it knows that it needs to do it if you've got a subsidiary that is set up in a currency that's not your functional currency. And the currency reval doesn't, so the currency reval shows up in the detail. I don't recall if it shows up as an individual line attached to the entry at month end. However, when you run the process, you'll see everything that's being revalued at that point. And is there a way to revalue all of the USD AP paid at the end of the month? With the average rate? No, usually so. No is the short answer. Not to my knowledge, because it's going to look at the AP in the fashion that I'm showing on the screen, where it is going to actually figure out how much you booked it at, how much you paid, and what the difference is. So, which is what ASC 830 wants it to do. So that kind of covers where you get realized gains and losses. The unrealized gains and losses, there is a spot, it's under financial. Revalue open currency balances. So here, these are the accounts that are set to revalue. When I save this, it is going to try to create an entry. Here's an example of an entry, because it didn't create any entries for me. So here it shows you what transaction it created in Canadian dollars, and you can go to the transaction and see what is coming through. So here's a journal entry. There's the transaction rate, the ending exchange rate, what the balance is in that currency, and how much the gain and loss is. And it is going to book this. So this is a Canadian dollar company with a US dollar amount. And it's saying that I need to adjust my Canadian dollar amount by $280. It will post this entry and then reverse it the next month. Basically, you rinse and repeat at that point. Again, it's going to select, if you remember when I went into the transactions financials, scrolled all the way down here to my revalue open currency balances. These are the accounts it's going to select. Note on intercompany accounts. I would suggest strongly that you pick a currency and stick with it. I have situations I've seen where a currency has been selected, say, for a management fee. So parent bills management fee to subsidiary in dollars. Subsidiary then pays management fee in foreign currency. It comes in the foreign currency, doesn't offset the dollars, and that foreign currency amount now is showing as an exposure on the revaluation. So pick a currency and stick with it. Normally people will use a currency of record for intercompanies in order to be able to address exactly this problem. For currency revaluation, there's a note in here that's a really accurate note and a good thing to point out as a gotcha. If you add something after that's going to affect your revaluation and you need to rerun your revaluation, you must delete that first entry. That is my experience also, Patty. So yeah, Patty's absolutely right on that. If you need to run revaluation again, delete that entry and start from scratch. Okay. CTA. We love CTA. No, we don't. When I go to my financial statements, there's my consolidated balance sheet. As we know, it's got a number of items in it. And there's the CTA, and it's big. And there's the CTA-E. I want to see what's in here. Here's the CTA-E, which is much easier to look at because it actually creates real live entries. And if you go in, so this didn't happen in this month, but let me find it. I get a lot of questions about CTA-E, and you can actually go back and find the entry, and it should show you the sources that are creating that CTA-E. So here, I'm going to go to the CTA-E account. Because I get a lot of questions, why do I have all this stuff in the CTA-E? And I should have a source transaction here. I don't in this case, which is unfortunate. Not sure why. However, as you do this, you will be, let's try a different one. No. So you should see a source transaction on these. So what it's trying to do, the fun thing about CTA-E is it's trying to take all of those intercompany transactions and take them out. In this case, there's a difference with the intercompany transactions. So here you've got, this is one, this is the offset, that's that offsets. You can get to this 1667 by adding up stuff that doesn't offset. Getting there is painful. If you've got a lot of it, it's really hard to try to figure out where this elimination entry is coming from. Currency, yeah, Patty, yes, I am reversing my revals. I suggest reversing revals. So here's my journal. That one's comparatively easy to find the detail around because remember, CTA-E is an actual entry. It actually, so here I can see that my subsidiary is my elimination subsidiary for my headquarters, and it actually posted an entry. Let's go back and look at my reports and look at my balance sheet, and you'll see that that is different for that CTA account, which happened to have $2 billion in it. So here, the currency translation adjustment. Remember how I said that this is not an actual journal posting that posts to a company? Here's that lovely CTA balance audit report. Now, if you want to see it by subsidiary, you do have the subsidiary drop down here. It's going to take a minute to load. and it's really hard to read. Let me select a Canadian account, refresh it. And this is the amount that I should be seeing for Canada. So if I go back to my balance sheet and just select Canada, oh, if I just select Canada, let me do this differently. So if I just select Canada, it's going to give it to me in Canadian dollars. What I want to see is I want to do it by subsidiary down here. And that way I can see what my Canada amount is on my balance sheet, and then I can go back to that CTA. So here, Canada thinks it's 285. And should be showing 285. It's not. Not sure why. But what this does is it basically says, yeah, I'm checking the date filters here to see if there's a date. Let's see, December 23rd. So, yeah, why I hate this report. Because it should tell me the CTA contribution for everything, and it's some unknown reason it's not, even though I have CTA. It normally does give you an amount, but it's really difficult to read. So it does show you, for example, what you're translating at, what your month-end general rate is, and it should be calculating over here. And I'm not sure why it's. However, if you need to see what the CTA contribution by company is, just run it the column by subsidiary and you'll be able to see. And again, it should be giving you a correct amount on your CTA audit report, which it's not here. Oh, there it is. Okay, no, it is there. Sorry about that. 2701, 156.35, but it's really difficult to read. So you're seeing where you're getting your differences here. Well, actually, it tells you, what it calculates at, and then the CTA. So total assets, total liabilities. So if I look at my liabilities and equity without the CTA, I'm at 65 here. And if I look at the income, equity. I don't know where to put the assets. It's, like I said, it's a very difficult report to read. I really hate it. I do side-by-side balance sheets. No, the calculation step does not need to be done in order for it to appear on the audit report. What the calculation step does is it calculates the average and historical rates for you. If you don't do that, and you've done it in the past, you'll still have CTA, so you'll still have something on this report. If you have never done the calculation step and you have never changed the amounts in the historical, well, actually, you'll still have an amount coming from retained earnings, but you will have a limited amount of CTA if you never change the average, because you will you'll be calculating everything at the same rate, except for retained earnings, because retained earnings, even if it's the same rate month to month to month, retained earnings by definition is addition of month 1, month 2, month 3, etc., that all have different rates. So you'll still have CTA, you will still have an amount on the audit report. However, your month-to-month reporting, if you haven't put in average, is going to be slightly off. Whether it's material or not is something that you would have to see with your auditors. They could do a calculation and see if there's a significant difference. Normally, the expectation under ASC 830 is that you'll be using an average rate for the period. It likes the way NetSuite does it best because it likes it on that daily basis. However, it's still completely happy with you doing it on a straight average. So you take the number of, you take all the rates for the month, divide it by the number of rates, you come up with an average. That's fine too. However, you would have to input that manually into NetSuite. So any questions about anything? I'd basically given myself an hour to stroll through content and then given lots of time for questions and answers. Is there anything that folks want me to go back and review? Now, some of this stuff is a bit thorny. So are there any items that people want to look at again? And you can,
yeah, feel free y'all to unmute if it's
yes.
easier.
Okay, let me walk you through. I have a question. Walk through how we can load the average rates. So we go to the consolidated rate table, consolidated exchange rates. I'm going to go to one where it's not in a closed period. So we'll not let you change it if it is in a closed period. You would have to open the period. So I'm just going to go down here. And here, for example, I'm going to do the UK. So I'm going to edit this. Oh, it's a derived rate. And I will talk about derived rates in a second and why those are annoying.
And Jennifer's added a piece here. Can you do it under CSV?
Yes, you can. Okay, so here I have called up this rate. Is it a close period? No, exchange rate derived. I need one that's not derived. So derived, if I go and I look at my dashboard, I'm going to do something here that's really useful for people who have, let me see if this is installed. There's a Suite app. It's not installed. There's a Suite app called Subsidiary Navigator. It's really helpful. It shows you a picture of your subsidiaries in the hierarchy. And if you have a situation where I have a subsidiary that's in pounds and it consolidates into pounds, then that company consolidates into dollars, it is going to say that the rate for that bottom one is a derived rate because it derives from that top consolidation. Be careful with that, because if you have a holding company, if you're expecting it to calculate the exchange rate with the understanding that it's going to calculate the exchange rate based on the average, and your top level is a holding company, it's not going to have very many transactions. And you are going to get a rate that is not representative. So that's a caveat on the calculation. Sometimes people will encounter that, and what they'll end up doing is they will end up going in and actually entering manual rates for those. So Let me see if I can do this one. Edit. I got one. Yay. Okay, edit. I go into my average exchange rate, I get 0.272, and then save it. Okay, so let's see what other questions I have here. Okay, can I speak more how to determine the FX exchange on the income statement and the balance sheet? Catherine, can you unmute and ask me that question?
Yeah, so I'm just thinking of kind of when you have those unique accounts where the currency exchange gain or loss needs to be presented, but you have to kind of drive whether you want it to be on the income statement versus the balance sheet. And a couple times I've run into that has been the long-term portion of intercompany debt. Is that only with that checkbox of revaluing?
Yeah, and that's only, and it's always gonna go on the income statement unless you try to drive it using the foreign currency account setups, but it should go. So if there's a realized or unrealized gain or loss, it should go in the below the line portion of the income statement. It's only the CTA that goes on the balance sheet.
And the only way to change that would be those settings, those mappings.
Right, exactly.
Okay.
Because it's trying to do it based on GAAP, and GAAP says unrealized or realized gains and losses in a particular entity are supposed to go into the other income and expense area of the income statement.
Okay, thank you.
So, okay, thanks. I was not understanding well.
A lot of
yeah. So if people have complicated questions, please unmute. It might be easier for me. Any specific setup needed for intercompany payables and receivables? Okay, and intercompany netting. Okay, couple things with intercompanies. If you want to use the intercompany netting feature, you must, let me find an intercompany account on here. There we go. You must tick the intercompany box, the eliminate intercompany box. And yes, it will do the CTA piece when you do that intercompany netting. Theoretically, on the balance sheet, if everything is working as it should, those numbers should match. But on your income statement account, as I walk through that example, you're going to get situations where very naturally you'll get a difference. So when you do everything, when you do your elimination entry, it will create that CTAE. If you're doing intercompany netting where you're trying to move things into the correct spot on the balance sheet. So for example, my intercompany receivable has a credit balance because I've been running everything through there. Or I have intercompany payable and intercompany receivable, and I need to net out and end up in the right place. So my intercompany receivable is greater than my intercompany payable. There's actually a feature that is just being released now that's the intercompany netting feature, and it will do the entries to move those correctly. The elimination entry will also do that. The intercompany netting one does that within the company itself. The elimination does it in the elimination company. So, yes, we will be sending out the links to the actual recording. So, what is important to set up for intercompany payables and receivables? If you want to use the automatic elimination, make sure to set up the eliminate intercompany transactions. As I said, another thing, just accounting hygiene, pick a currency and stick with it. So decide what a currency of record for your intercompany charges are going to be. What some places do is if it's a receivable, then it is in the currency of the person whose receivable it is. So if I have an intercompany receivable between parent company and company A, and parent company is the dollar, that intercompany will be denominated in dollars. If it is between company B and parent company, where parent company owes company B and company B is a euro company, that will be denominated in euros. The important thing to note there is, where is the exposure going to end up? Who's going to take that unrealized gain and loss piece on their income statement? I've heard various views on that. There's no right answer. One view I've heard is it's the problem of the local subsidiaries. It goes on them. The other viewpoint is it is something where we want to track, it's a cost of doing business overseas, and we want to track that at the parent level. So there's more than one consideration. Really doesn't matter, but pick one currency. Do not mix and match currencies in your intercompany accounts, because when you come to revalue, you can get a situation where you have, say, a $200,000 intercompany balance on a consolidated basis, but you've got, or not on consolidated, on a, on an entity basis, but it's showing that you've got exposure of 500,000 euros, which clearly doesn't translate to $200,000. So it's really important to pick a currency and stick with it. I cannot emphasize how important that is. If you do that, then you'll get a natural elimination happening on an intercompany level. So I've got US thinks that Canada owes them $1,000. Canada booked it at $1,000. It was $1,300 when they booked it. Now it's 1,250 Canadian dollars at month end because they've revalued it. The 1,250 now gets translated back at that month end rate, because the rate that you revalue at is the same rate you translate at, and now it translates back to $1,000 US, eliminates nicely, no muss, no fuss. If you already mix it, I suggest that you figure out which currency. So you've already mixed it. I've got an intercompany account that's got pounds and dollars in it. I've got this same situation where I show that I've got $200,000, but I've got 500,000 pounds that it is showing me as my exposure. In other words, it's the amount of foreign currency that I have that I need to revalue, which is clearly not true if it's $200,000. So what my suggestion is determine the currency, determine what the correct balance should be for that currency. And then you'll need to do 2 entries. So you need to get rid of that other currency balance. So what you would do, so that 500,000 pounds, for example, constitutes 100,000 of the US dollar amount, for example, which is really wonky. You're going to get some weird exchange rates. But what I would do is do 2 entries. So I'm going to do an entry in pounds to remove the pound account and put the offset in a pass-through account somewhere. I usually do it in realized gain or loss because I usually get a few pennies that are different. And so I throw it to realized gain and loss and call it good. And then I rebook that 500,000 pounds in the appropriate dollar amount. So I've gotten rid of any pounds that are just in the background on that account. I decided at the beginning that US dollar is my currency of record. I now show everything in US dollars. The reason that a lot of people will do the receivable is they choose the currency of record to be the receivable side. That's so if there's charges going both ways, it can happen in different currencies. and it will actually get taken care of appropriately. So the receivable side on parent book is US, receivable side on UK is pounds. UK charges US pounds for expenses they pass through to them. US charges UK dollars for what they pass through to them. And so once everybody revalues, life is good and it works. So, best practice, where goods are paid for before you set, and can you elaborate on the use case for that? Because I'm seeing that, okay, so Michelle, you're saying, so your question, what would be the best practice for some goods that are paid before you set an exchange rate and then receive into inventory a couple weeks later? Well, the cost of the inventory is the rate of the day at that point. Because I mean, there's a prepayment on a piece of it. But I think from an accounting perspective, that portion of it would be at that rate, and then the balance comes in. That's a good accounting question. The balance is received into inventory at one rate. And the invoice being paid at a different rate is I assume you're not trying, well, actually that's a question. Are you trying to revalue the inventory based on the difference in exchange rate from when you actually initially received the inventory and when you paid the invoice?
Hi, is it better if I just say it verbally?
Absolutely, please.
Okay, sorry. Now I don't have an accounting background. I'm just trying to understand from an accounting perspective what is the best way for us to be doing, just to make sure we're doing it correctly. And so we bring in goods by container from overseas, and so we are paying the vendors before, like well before the goods arrive in a lot of circumstances. So we know what the rate is at the time that we pay. So I'm assuming we put that rate on the prepayment when we put it in, or
are you prepaying the whole? Are you prepaying the whole thing?
Yes.
Okay.
Or
so if
parts of it. Sometimes we pay a deposit and then we pay the balance, but it's well before we receive and cost into inventory. So the rate might be different.
Right. So how do you? Because normally, I mean, how are you? I assume you're doing like average cost, not standard cost.
Yes.
Okay. All right, because that was a question. That would have been a question too, because it would have been different answer. Okay, so when you order it, normally it would go in at the rate at the time you receive it.
Right.
And so let's say I do a PO for 500 pounds. That is $700 US. And it's X pounds per item. When I receive it, it's going to say, okay, you received it 10 days later, 500 pounds worth of stuff, $720 US. That's what's going to go into your inventory. So you're going to debit inventory for that, and you're going to credit AP. Or you're going to credit actually accrued. That's going to be accrued receivable, an accrued item, because theoretically you have disconnected that receipt process from the invoice. Then when you get the invoice, you're going to put that in. So that is going to be for 500 pounds. That's going to be X amount of US dollars. Now you're going to apply the prepayment against that. So it's going to be, say, $750 US is your invoice. You've got a prepayment of 250 pounds that got brought in at $375. So you still owe the other 250 pounds. That is going to be, say, $375. so you've got that $750, you brought it in at $720, you got $30 of realized loss. I wish I could draw T accounts because it would make more sense. But normally the way the system is going to try to work is it is going to try to book it. If you do it as a purchase order and then a receipt, even if there's a prepayment, it's going to try to book that receipt in at the day you receive it. And it's going to fix the value at that point.
Okay, so it doesn't recognize that we've already paid for that shipment. So when we apply that payment, okay.
No, that's a different, because when you apply the payment, so because you're going to get the full invoice, right? And you're going to apply the prepayment against it.
Mm-hmm.
And then you're going to have to pay the balance. Yeah, it can get challenging.
All right, thank you very much.
Okay. All right. So the next question is, if the currency on the receipt and the bill are different, yes, that is where foreign currency variance account. So yeah, that is where it's gonna. So are you trying to float that foreign to Ryan? Are you trying to float that foreign currency amount back to your inventory value? Or are we just posting that? Because the question is, if the currency on receipt and the bill are different, it's that where the foreign currency account, variance account on the item records and the PST vendor bill balance is paid. So it's a post vendor bill balance. So it's gonna, for invoices, it's gonna try to post the difference between what you booked the bill in at and what you booked the payment at. It's going to try to post that to realize gain and loss. I'll be honest, I'm not sure about flowing that back to your inventory costs. I will have to do some research on that. I haven't run into that a lot, but Ryan, have you seen? No, yeah, wouldn't flow to inventory cost. Correct. I haven't seen where people have tried to flow it back to inventory cost. Generally, inventory, you receive it on X date, and that's when that's the rate that you book it in at. And if there's a difference between what you got the bill at when you put the bill in and what the amount is when you pay it, is going to go to realized gain and loss. How do currency revals apply to JEs? If the JE is posting to an account, remember it's on an account basis. If you post an entry to an account that is set to revalue and you post it in a currency that is not the functional currency, it will attempt to revalue that amount that you've put in, which is why you want to be careful about, again, mixing and matching currencies. So if I debit an account for $10 with a JE, and I'm in a UK company, and then I credit that same $10 amount, but in pounds without doing it in dollars, now I've got a debit of $10 that's sitting there, and it's going to try to revalue it, no matter if you've done an offset for it. So let's say that account was $0. It's still going to try to revalue because it thinks you've still got that $10 there. So you got to be careful. Any other questions? I know that this stuff is complex and gives a lot of people a headache, and I don't blame them. Anything else? Another one. Okay. When moving from a TB import report to actively transacting. I'd like to shift to a daily update rather than a plug. No, it'll do it automatically. You just go in at the end of the month and do the calculate process, and it's going to go, because normally if you just done it a month end and you hit the calculate process, it would just pick up the month end rate because you only had 1 day for it to calculate on. But if now you're going and transacting in the system, it's going to go, okay, on the 1st, you've got these, and on the 3rd, you've got these, and on the 10th, you've got these, and I'm going to do a calculation, and here I am, I'm going to give you an average rate. And you don't have to tell it that you're changing how you're doing things. It is a purely mathematical exercise on its part. It looks at the transactions that you've done, and it doesn't care if you if you did 1 transaction or 25. So calculating when you don't have full account history. Ooh. Historical rates, if you're bringing over, Jennifer, is this for you're starting up? You're bringing over an opening balance, or is this on a?
Yes, yeah, when you bring in opening balances.
Okay, truly horrible to try to do. I will warn you that. What you can do that is really clue. So let's say I've got 5 accounts. I'm doing a historical opening balance. I've got 5 accounts that all have 5 different historical rates. I literally do entries for 5 months going back. I literally do an entry for, figure out what an offset, a good offset account would be for it, so that I can freeze that.
Okay, I think that's kind of where we were at. I just didn't know if there was an easier way.
Oh God, I wish. It's horrible. I hate it. Yeah, there's no good way to do it. So if you're bringing over, because you do get that where your common stock is different from your paid in capital, from your retained earnings. Yeah, there's no good way to do it. Okay, FX with bank fees.
Yeah, it's make a simple like a journal entry here and think through it, because we have a foreign subsidiary. We wire them money to pay the bills in their currency, and obviously NetSuite's calculating the FX rate, the proper FX rate, but the bank
is going to be different.
Yeah, bank's going to charge all kind of junk fees and different rates, et cetera, et cetera. And
you override the rate.
Okay, and
you can override the rate. Yeah.
So then, let me ask you this: so if you override the rate, then that entire difference will actually go to FX, realized gain or loss eventually, and some of that's really bank junk fees, or a lot of it's bank junk fees.
You book the junk fees separately.
Right. So how do I know that? I guess, is that a bank issue? Because the bank does not tell me this part's a junk fee and this part's are extended FX.
If they don't tell you, you have no way of knowing, and you have to treat everything, because if they've buried $15 in there and they don't disclose it, you think that you're sending out $1,000 that translates to 815 pounds, not realizing that they also charged you $15 in that. Because usually that gets, so is it on the receiving end? So that 815 pounds includes 15 pounds of fees?
Yeah. So basically the simple illustration would be, I send them $1,000 US, and the FX rate says they should get 750, but they end up really only getting 650.
But you don't know that there's $100 in there? They don't disclose that?
They don't disclose the difference between their FX rate and their junk fees, because they have to use an intermediary bank as well. And so I'm switching banks, but in the meantime, how do I?
So it's just a lump sum. So you're going to have to force it and just, because you got no way to figure out what the fee portion is. So you just override the rate. So when it gets received on the other end, so let's say you do it by an advanced intercompany journal entry. Cool. So let's look at the advanced intercompany journal entry. Transactions, financial. So your advanced intercompany journal entry, what you're going to end up doing is once you select the subsidiary that it's going to, you're going to be able, so here, if I do subsidiary Canada, currency is going to be US dollars. You'll end up having to force the rate. Oh, where's the rate coming in? Because Canada, it's going to try to bring it in Canadian.
Correct.
So here, if it's coming from
Come from US to, let's do US
Right.
to Canada.
oh, hold it. Let's check it. Let's use a US. There we
Right.
go. So here, there's US. It's going to go to X account. But once you get to Canada, it's going to want to translate it,
Right.
and there's going to be a spot to do the rate. So you're going to force the rate so that the Canadian dollar comes out correctly.
Okay, and so then just don't worry about the actual junk fees to go to bank expense or bank
Yeah.
fees.
You have no way of identifying them.
Yeah.
What you're telling me is you don't know whether it's $10 or $100. You just know that there's rubbish in there.
Okay. Okay, because what I did, and maybe I obviously did it incorrectly, is I just threw it all into bank junk fees, because at the end of the day, that's kind of what it is. And I thought NetSuite would calc the normal FX rate.
Well, but the problem is that there's no quote unquote normal FX rate, because basically the FX rate is going to change from minute to minute based on, and that's why the bank, and the bank always has, they have a spread in their rate. So it's never going to match what the quoted rate is.
Right.
Because they take a spread. And it's, it's not necessarily bank fees there. It's their spread. So they want to make money. So they buy at X. And, if you look on, even on quotes, your buy rate and your sell rate are different because there's
Correct.
a spread there. Right. So, there's no way to identify what the spread is necessarily, and how much of that is maybe a $10 fee that's in there, and how much of it is spread. The fact is that from an accounting standpoint, it's whatever the bank is charging you, and there we are.
Right. Okay.
So
I wonder how I revert. I'll think through that and how to reverse
Okay.
that, I guess, because at the end of the day, it's going to an expense account, either the bank fees or realized gain or loss, right?
yeah. And if you don't know how much the bank fee is, it's just going in your gain and loss, because you have no way. So I mean, yeah, because if it's a different amount, if the bank, if again, it's you get that realized gain and loss when you settle the transaction. So you got an invoice, you pay it, bank may charge you, more or less than the quoted rate on the market, but it's still the difference that you're really looking at is the difference between what you booked it at and what you pay it at.
Okay, so basically, just tell our auditors, don't worry about it. It's going to all go to FX.
Because you have
we know it's junk fees, bank junk fees.
Right. Well, and bank spread, you're going to have some bank spread there, and the auditors, the from an accounting standpoint, it's what the bank charges you, not what is quoted on that particular day.
Okay.
And the auditors should understand that. Because the bank is not going to quote you the market rate.
No.
Ever.
Right.
Because that way they don't, if they do that, they don't make money.
Yeah,
exactly. So, you can show your auditors, this is what the bank charged us. And they go, okay, that's what the bank charged you.
Okay.
So you want to prevent NetSuite from creating currency revaluations. It is in fact as simple as unticking the reval box on the record. It will stop trying to revalue that account if you untick the box. So I've seen situations where people have gone back and had boxes tick to revalue and then gone, wait, that's not a monetary account. I don't want to do that anymore. They untick the box. Simple as that. Any other, got 2 minutes left. Any other quick
Yeah,
questions?
I want to add, just for anybody, I did post a link earlier up, a bit.ly link, if y'all could take a minute and just do an evaluation of this meeting. This is the first time we've done one of these kind of focused meetings, so we're curious as to your feedback on how it went.
Yeah, and you know, hopefully, I was trying to answer everybody's questions, both in the chat and so maybe I should have held questions for the end, but that, you know, I tried to answer as we went along as well. Hopefully that was not too distracting. If it was, if there's a way for me to do it better, please let me know. There is the feedback link again. Really appreciate so many of you coming out. This was amazing turnout. Really happy with it. I am going to post my email address if people have follow-up questions. So please feel free. Oops, that was a direct message. Hold on, let me fix that to everyone in meeting. There you go. So there is my email address. Happy to answer questions, point people in the right direction, kind of help, you know, if there's stuff that's quick and easy troubleshoot. I'm having a problem with this. Have you done this? So thank you again, everyone, for attending, and look for the recording to be posted. You know, I assume in a few days, because I know that
usually about a week or so. Yeah.
Yeah, within a week or so should be posted.
Okay. Where will you post the link to that, Corey?
Well, it's always, all of our recordings are on our website under the posts section. And so the link will be there. I'll also post the URL to the post on our LinkedIn forum. And then also just in greater LinkedIn messaging as well.
Okay. All right, everyone. Thank you all so much for your time.